Hello, everyone, and welcome to our webinar. My name is Saar Menachemi, and I head up DealCloud's marketing and business development efforts. Today, we will share the results of our inaugural Dealmaker Pulse Survey that was taken in the spring of this year, along with data-driven takeaways specifically for private equity firms and fund managers. Before we begin, we wanted to take a moment to review a few housekeeping items. We, the DealCloud team, and myself included, are currently working from home, in my case, in Queens, New York. So there may be an occasional background noise that we hope you excuse. As Zoom experiences high usage volume, we may experience connectivity issues or slowness, and while this is unlikely, it's worth mentioning that if we or you have any issues, this session is being recorded and will be sent to all after the webinar is finished. Lastly, participants can submit questions during the webinar via the Q&A function. We will answer questions live at the end of the presentation. With that said, let's get started. For those of you I haven't had a chance to meet, I joined DealCloud 3 years ago, and it coincided with the launch of the current version of the platform. I joined DealCloud with a long history of working with private equity firms and fund managers throughout my career. Before joining DealCloud, I spent many years at iLevel and subsequently at iPrio's private capital markets group. And before that, I spent many years as well with Intralinks. I'm excited to share the results of what we gathered. But first, I thought it would be helpful to give a little background on how we conducted the survey itself and ultimately how we were able to crunch the numbers that we did. We issued the Dealmaker Pulse Survey the last week of April so that we could gauge the trends and issues affecting private equity professionals, since we all know at this point that the reality on the ground has changed so dramatically in the last few months. For those not familiar with our technology, DealCloud offers a deal relationship and firm management platform, and like our almost 900 clients, we use our own technology for all of our internal operations. We drink our own champagne, so to speak. And that includes our marketing solution, Dispatch, for which you're seeing a quick preview on the screen right now. For the survey, we use Dispatch to create the survey's webpage, to distribute emails asking private equity investors to participate, and to collect the anonymous results that we're presenting to you today. And while we're not conducting a demo on this webinar, we are happy to show you exactly how DealCloud or Dispatch can work for your firm. If you're interested, I would encourage you to visit www.dealcloud.com. You can browse the information there or request a demo, and a member of our team will follow up with you. Starting at the top, we thought we would spend a few minutes talking about the firms and respondents themselves for the survey. We surveyed fund managers, the vast majority of which were either private equity buyout funds or had growth equity strategies, and we're thankful to all of those that responded and provided their insights for this survey. As you can see on the slide, many of the responses are from investment professionals. But we also had a fair representation from investor relations and marketing professionals. We have a large representation from those who identified themselves as either members of the firm's executive committee or who were partners or managing directors. In fact, 63% of the responses came from senior people at their firm if you look at everyone who identified above the VP level. We also saw a fair spread of firms of all sizes, ranging from boutiques, many with less than 10 professionals, to larger firms with over 100 professionals, and truly all shapes and sizes in between. And we feel that all firms are fairly represented well in these results. Let's take a look at the findings from the report. The first question we asked was, what is the primary focus of your firm, but specifically over the next 6 months? And in looking at the answers, it's obviously hard to ignore the top two here, which are acquiring new companies and working with existing portfolio companies on improving operations. If you look at the third most popular answer, though, which is rolling up or bolting on to existing portfolio companies, and you combine that with acquiring new companies, we can see that 52%, or the majority of firms surveyed, are focused on acquiring companies in the next 6 months. And I see two main takeaways from this. First, if the majority of firms that responded are primarily focused on acquiring companies, competition might be higher in some areas than previously anticipated. And we'll talk about expected deal flow sources in just a few moments. It's part of the survey results. Second, the firms that are focused on existing portfolio company operations might be at a disadvantage, as the vast majority of respondents also felt that valuations are expected to drop. So if your firm is really focused on portfolio company operations, but you have dry capital that needs to be deployed, it might be time to reconsider that and devote some efforts to sourcing new transactions. Something on this page that could potentially be seen as good news is that the majority of firms are not primarily focused on the effects of COVID-19 and the disruption it's caused. I'm hoping this means that many firms have stabilized their portfolio companies and that we're moving past the initial disruption that we've had. We thought it would be interesting to look at this question and the answers to this question based on the respondent's role or seniority at their firm. And on the left-hand side, we have those that identified as partners or managing directors. And on the right, those that are VPs on the deal team. The good news is there seems to be general alignment between VPs on the deal team and those that responded as partners or managing directors. There are a few interesting and notable differences, though. The first one is VPs responded 10 points higher that they'll be focused on working with existing portfolio companies. And it's likely that because they work with portfolio companies in a day-to-day fashion, that they might feel the quote-unquote pain of working with companies during disruption more acutely, which is why we think we're seeing the high numbers listed there. Partners and managing directors are likely more involved in their firm's operations, which is why we think we're seeing a higher focus around mitigating the effects of COVID-19. And we think this is likely because they also have to factor in investor requests, potential current or future fundraisers that have been paused or maybe even reevaluated, and many other factors into that equation. The next question we asked was, what are the challenges or barriers that you see to execute in today's market? And unlike any of the other questions on the survey, this is the only one where respondents could give more than one answer or check all that apply. We learned that while firms are primarily focused on new deals, they are overwhelmingly concerned about the volume of deal flow hitting the market and ultimately their ability to secure financing for those transactions. And I know for many of you on the phone, this might be a concern in the best of times, and it is certainly top of mind now more than ever. Because of this, we are hosting webinars tomorrow and Thursday for investment bankers and lenders to encourage them to ramp up their sponsor coverage efforts based on the top 2 bullets that you see here. Echoing the results on the previous page, the third most popular answer here was attention on existing portfolio companies. As many of you know, these 3 reasons are also why so many firms have created dedicated business development or capital markets or operating partner groups in recent years. And our takeaway is if your firm doesn't have these functions handled by dedicated people, that perhaps now is the time to reconsider. And in looking at these results, it's possible that we aren't that far away from not having these as dedicated functions at your firm truly being a competitive disadvantage. Interestingly enough, the 4th most popular answer here is irrational prices, which is coupled with increased competition. And while almost everyone agreed that prices will generally come down or valuations will generally come down, it's possible that the amount of dry capital available and the potential rush for deals might mean that, although true, prices are coming down, that doesn't necessarily mean that prices are low. We thought it would be interesting to take this question and again break it down by role and seniority in a side-by-side comparison. And the number 1 answer for partners and managing directors was in finding financing for transactions. But VPs on deal teams feel that they are not seeing the right deal flow. Partners are more focused on existing portfolio companies as a challenge for executing on new transactions, whereas VPs, who are likely doing more underwriting on transactions, are looking at valuations more day to day and likely seeing this as an issue. And in third place, we have sourcing challenges and portfolio company focus. Now, the reason we thought it was helpful to do this breakdown in this side-by-side manner is there seems to be a disconnect in challenges or perceived challenges based on the role that somebody plays in their organization. For everyone with a perceived challenge, it's easy to assume everyone views your concerns as their concerns as well, but we are finding that this is not the case. And if you feel that there are obstacles that your firm is facing that you need to overcome, it's probably best to level set within your firm and have a unified strategy for how your firm is going to go after it. We also believe that this issue will likely get worse over time. So the takeaway here, or the question that we would pose, is why not use the summer to align your firm's priorities? Next, we wanted to focus on that sourcing question and asked firms where they anticipate their deal flow coming from, again, in the next 6 months. And in this case, respondents could only choose one single answer. And there's an interesting split here between large firms and boutique firms that responded to the survey. Large firms, as you can see, are clearly focusing on corporate carve-outs as a major deal source, and with the likely potential for many corporate distressed assets, maybe that's not that big of a surprise to many people. What might be a surprise, though, is that if your firm is hoping to buy a corporate carve-out, it seems that many other firms are expecting to do so as well. So we anticipate that there will be the most competition here, since not only large firms, but also 25% of boutique firms view this as their primary deal source. Recaps are the second most popular answer here, but weighted heavily to boutique firms. If we tie it back to the challenges we saw earlier, and if recapitalizing debt is part of your strategy, then this speaks to the importance of having the right coverage model in place for lenders, or again, the importance of standing up an internal capital markets team if your firm doesn't already have one. Given these numbers, generally speaking, having the right market coverage strategy, in our view, is of the utmost importance. And of course, shameless plug, technology is a key part of that model that enables that coverage strategy. And honestly, this could be as simple as ramping up deal announcements or announcing key hires at your firm, or even just, dedicating certain people to cover key relationships in this time. What that brings us to is the last question that we had asked on the survey, which was, how does your firm view technology and ultimately its impact on your firm? 49% of respondents said that over the last 6 months, technology has allowed their firm to stay about even or on par with their competitors. An additional 31% agree that technology has enabled them to beat their competition in the last 6 months. So I'll do the math for you. That left 20% of firms who don't feel this way. So if you fall into that 20% category, the real question is, why allow yourself to fall behind? What we've seen, and especially in the last 3 months, is many firms, including our clients, long-term clients, new clients, are taking this time to reevaluate technology, but honestly, more broadly, to reevaluate their entire firm's operating model. If you feel that your firm's technology is not at least letting you stay on par, there are many technology platforms and data providers that can help, and we truly believe that those solutions can help you succeed better. That brings us to our key takeaways. And we talked about these earlier in the presentation, but we thought that they were important enough to reiterate again here at the end. We believe firms need the right coverage model, and that is ultimately going to drive the need for dedicated business development, capital markets, and potentially also operating partner groups. Many firms that we are talking to about reevaluating their technology to better enable their firm, and many firms are spending this time to realign their firm's focus and strategy to make sure that everyone is paying attention to the right things. The last takeaway here is around deal sources, and we're seeing corporate carve-outs and recapitalizations listed as the most popular, and firms should expect the most competition here. We hope that the information shared today provides you insights into potential opportunity for your firm. DealCloud offers a deal relationship and firm management platform that can help you take advantage of this opportunity through the right sourcing, coverage, and execution tools that is already leveraged by nearly 900 firms globally. DealCloud also offers marketing, fundraising, and investor relations solutions for private equity firms and fund managers of all types. For additional information on how our technology can help your firm, please visit dealcloud.com. Let's open it up to questions from the audience. There is a Q&A button at the bottom of your Zoom window where you can ask questions, and we will answer them live here on the call. The first question that came in was, do you think these trends will affect fundraising? And the answer, I think, is I think it will. We'll have to wait to see. PitchBook and Preqin put out great reports around fundraising, and I think we're going to see a slight dip as it related to the trends that we had in fundraising. I do think that many firms, especially the ones that were out in March or the ones that were planning to launch this summer, likely took a step back. That doesn't mean that we won't see fundraising. I just think we will see an effect on many firms' ability to fundraise or potentially reevaluate the time of going to market or potentially focusing on re-upping existing investors. The next question that we got here was, what kind of technology are most PE firms you spoke to using? Is there a difference between big firms and boutiques in what they are using? That's a good question. I would say the best way to think about technology for many of these firms is to look at it as front, middle, and back office. In the back office, that's historically where most firms started rolling out technology. And many firms have either rolled out an accounting or general ledger platform, something like an Investran or an eFront. And many firms will leverage a fund administrator to do that as well, that are ultimately leveraging technology to do that too. And I think that's the biggest difference that we see between large firms and boutique firms, the ones that outsource versus the ones that manage in-house. In the middle office, generally speaking, there's a lot of options for you in terms of monitoring your portfolio companies. And we've recently done webinars with firms like Cobalt and Maestro that we would recommend you take a look at. And in the front office, there are obviously CRM and deal management platforms like DealCloud, but also lots of great data providers that can provide information like SourceScrub, a Privco, a Sutton Place Strategies, a PitchBook, a Preqin, a FactSet, or a CapIQ that can greatly aid in sourcing and coverage, and that tie directly into many of those platforms that we mentioned. Another question that came in is, what technological capabilities help firms beat their competitors? I think that's an interesting question. And a lot of that has to do with understanding the market, understanding who you need to talk to that day, and quite honestly, just doing things better than sorting an Excel spreadsheet. So many of these capabilities have to do with either being aware of transactions or companies that are available, looking at precedent transactions that existed to be able to better understand multiples or pricing. It's about understanding, maybe what other sponsor is ready to sell a piece of their portfolio. It's about saying, hey, you haven't spoken to this person in 30 days. It's time for you to follow up. It's about having the capabilities of looking across multiple lenders and seeing who's giving the best rates. All of those are technological capabilities that we think that help firms compete better. And again, if you're interested in that, we can take you through how the DealCloud platform can help solve many of those questions. The next question that we get asked here is, can you give the specifics of how you use the DealCloud dispatch tool to issue this survey? And that's a good question. So for those of you not familiar with dispatch, it has a few capabilities. The first of which is creating what are known as landing pages. Think of those as web pages where you can post any type of information that you'd like, but that web page also allows you to collect a response. Now, in our case, we collected the results or the answers to the 10 questions that we had asked. Your firm might use that to do things like register people for annual meetings. Some of our firms are using it to collect teasers or SIMs and have it uploaded directly into their DealCloud platform. Other clients are using it for companies are able to upload basically pitch decks for them to review. Dispatch also has email capabilities, and we use those emails to send out the survey to people and ultimately ask them to click the link and drive them back to the page. But we use those emails capabilities as well for things like newsletter distributions and new client announcements, no different than how your firm would be able to do things like send out your newsletters, send out deal announcements, or send out holiday cards. The next question we have here is, do you see technology being used in pre-deal due diligence? And absolutely. There are many platforms that can aid in the pre-deal due diligence. We actually had this as a topic of one of our webinars. I would encourage you to take a look at the webinar called The Future of Work in Private Equity that we hosted just a few weeks ago. There are many platforms, DealCloud included, that have workflow capabilities and checklist capabilities that allow you to create diligence tasks and follow up on them, and the ability for you to execute on a transaction. Another question that we have here is, what is the recent executive order around private equity getting the ability to get 401k contributions, and what is its impact in your mind? And I think that's a good question. Ultimately, I think, look, the more dollars that are funneled into private equity, the more likely it is that there's going to be competition for assets. And if you follow that train of thoughts, competition for assets generally means you need to track targets that you're looking to buy very diligently, because it's likely that someone else is tracking them as well. It means that you need to have the right coverage model for intermediaries or lenders or brokers. So that generally requires discipline and technology. And, you know, look, the amount of dry capital that's been raised over the last few years has honestly caused many things in the market to change, valuations to go up, many new firms to start. You know, this is almost like the next version of that. And many firms that we're speaking to are looking to get ahead of that wave. And even firms as small as 5 people are looking to get technology in place so that they can better kind of cover the market and execute on their strategy. There's another question here that just came in around dispatch. Is dispatch typically used externally, or can it be used for internal surveying data collection as well? The answer is both. You know, we've used dispatch internally. We use it to communicate internally or to send emails or announcements internally. But it's also used very heavily externally as well. And if you've ever received either an invite for a DealCloud webinar or a newsletter from us, then you've received a dispatch email, and you can see the sort of look and feel for it. The benefit of dispatch emails is that there is an option that allows you to track clicks and opens. So if it is important for you to track internally whether somebody received a data collection request, or that you want to capture information through a web form, absolutely you can use dispatch for that. There's one more question here listed that says, will you issue the survey again? And if so, how do we participate? And the answer to that is yes. Our goal here is to issue this survey twice a year, once in the spring and once in the fall. So we'll be issuing the next Dealmaker Pulse survey at the end of October or sometime in that time frame. And the best way to participate is simply to download the report that's available today, and then we'll make sure to add you to the list of people who have the ability to respond in the next round. That's all the questions that we've received, and it looks like we're hitting the top of the time that we've allotted here. So why don't we move directly to some final thoughts here. If you're interested, please visit dealcloud.com/pulse to download our full report with all the information that we reviewed today and more. As a reminder, this webinar was recorded and will be made available on our website shortly, so feel free to rewatch this or share it with your colleagues who may have missed this information. Additionally, we'll be hosting another session tomorrow for investment bankers and on Thursday for lenders and credit funds. Lastly, visit dealcloud.com/webinars for more information on our other upcoming events. Thank you again for joining us today, and please stay safe.